Patrick, I'm writing a book called How Money Really Works. We put our money in a bank, and they were only paying us like 1%. Mm-hmm. So you can do 4 things with money. You can spend it, lend it, own with it, or give it away. Mm-hmm. So when money is at a bank, credit union, or an insurance company, it's in a lended position. Does that make sense?
Yes.
Okay. Why are they borrowing our money and paying us interest? Are they just a benevolent institution? No.
Nothing.
What are they doing with our money? They're borrowing our money, $1 million, and paying us 10 grand. Now in 2008, they disclosed right off the bat, they're taking 30 to 40% of their tier 1 assets and they're turning around with that money, and guess where they're putting it? Right where I just told you,
right.
In the insurance company. Because the insurance companies are usually rated AAA, the ones I put my money in. A lot of banks are only rated BBB. So they borrow our money at 1%, put it into an institution ranked 6 notches higher in safety, and they're earning 5%. How much more is 5 than 1?
4?
No, it's 500%.
How so?
Would you hire an employee for $10,000 that made you an extra $50,000?
Sure.
That's called a 500% return on employment cost if you're a business owner. Would you buy a widget machine for 10 grand if that widget machine made you an extra 50 grand?
Of course.
It's 500%, not 4%.
Wow.
Does you get it?
Yes.
And they're doing it on OPM, other people's money. All I tell my clients is you can bypass the middleman. You can take your money, increase the liquidity and the safety and the rate of return, and you could be earning 10 tax-free.
So this is then the real business of the banks, is what you're saying. You know, not making money on mortgages and some loans or what other things they might do. It's just a part of their, but really their biggest business is what you're describing.
Patrick, the banks could do far better if they did not loan 1 dime to the public. But they can't get away with doing that, or people would stop bringing money to deposit it into the bank. But the bank can more predictably and safely borrow our money and put it into these types of instruments, but it's also the velocity of money. Mm-hmm. So I often ask my audiences, why in the world would a bank or credit union who can borrow our money at 1% and they can turn around and earn 5 times that, tax-free, right, ever want to loan you or me $1 million to go buy a home or something like that? People go, well, because they have to? No, there's no regulation that says they have to. I mean, if we didn't give them the money, maybe we would stop doing that, right, but that's not the reason. So if I go to a bank and I borrow $1 million to go build a house, what am I going to do with the million? I'm going to give it to the general contractor.
Right.
What's the general contractor going to do? Take his piece, pay his subs, mm-hmm, and the suppliers. Mm-hmm. What are all of them now going to do? Loan that $1 million back to the bank again. It goes right back into the banks. The banks get it back in a week or so at 1% or less if it's a checking account. They get it back again and they loan it back out again at 500%. Mm. The average bank will loan out and receive back, okay? They'll do that 17 times. They'll turn over the same money 17 times a year, only 12 times a year in a recession. Shucky darn. So see, they can afford to take risks that if I lose my job and they have to foreclose, they don't want to foreclose on my house, but they've calculated that in there. But if they can borrow OPM, other people's money at 1% and loan it back out again at 5%, at 5 times, 17 times a year on the same money, that's called the velocity of money.
Wow. So this really starts to sound like a racket.
It's called the banking industry, but it's not new. This is the parable of the talents in Matthew 25 in the New Testament. This has been around for millennia.
Wow. So, you illustrated so well as far as, the analogies that you weave into it so that it's something tangible to us lay people, that go out and work every day and not see this, this sort of look behind the curtain.
Yeah.
So so when you start to look at, okay, so we got banks, we got the government, and we see, how literally, I don't know that I'm going to say it's totally malevolent, but it seems like it's rigged against producers, right? That the system is, that these people are locked in and they enslave the producers in the ways that with inflation, with taxes, et cetera, with the relending of your money, because if I buy, like you said, if I borrow the money and I go build the house and something happens to me, I'm at risk. Then next thing you know, maybe I'm bankrupted in the house, but they don't care because that money is trickled back to them over and over again.
Oh, yeah.
17 times.
Yeah.
So where could I get into that business, right? You know?
Well, in a lot of my books, I talk about how to become your own banker.
Right.
Okay. I'll give you a little taste. For example, in my max funded insurance contracts, let me use an example of an actual friend, a client of mine who is a real estate developer. Okay. What he does is he buys strip malls, large apartment complexes that people want out of. He will fix them up and then flip them to somebody. He doesn't like to keep them and be a landlord.
Right.
So he has a pool of investors looking for fixed up properties, and he goes out and finds the distressed properties. So where he keeps his working capital is where I do in my insurance contracts, because it's very liquid. You can access your money with an electronic funds transfer or phone call. Okay. So many times he might call and he'll say, Doug, I need $1 million out of my insurance contract to tie up an earnest money agreement on a $30 million project I want to buy. I go, great. How soon do you need it? And if it's a week or so, we can just do it normal, but he says, I need it tomorrow. In the insurance contract, he can get that electronically. We can overnight it or whatever. Now, he says, send me the form. It's 1 page. He puts his name, he puts his account number or policy number at the top. He's going to sign it on the bottom. He doesn't have to have his signature notarized unless it's going to a different bank account or address than on record. And the one sentence, the one question that he must answer is, do you want to withdraw $1 million out of your insurance contract, or would you like to borrow $1 million? Guess which box he checks?
Borrow.
That's right.
Yeah.
Here's why. If he withdrew the million that is, and he's been averaging about 10% like me. So if he withdrew it to do this and he didn't pay it back for a year, he would relinquish $100,000 of interest on 10 grand on that million.
Right.
He doesn't have to do that.
So he keeps the full principal balance for his rate of return, and yet still has access to capital to be able to do his.
Yeah, in other
entrepreneurial
words,
project.
let's say you went to a bank to borrow money and they said, well, you have a savings, a CD here. You can use that as collateral. We'll loan you the money. But
Right.
see, the banks will loan you at 5 and they'll only pay you 1.
Right.
No, this is different. With the insurance contract, the insurance company says, oh, heavens, yeah. We'll loan you the equivalent of your cash value in here. And so you'll just leave it here and we'll keep crediting you with this indexed return. And we'll loan you $1 million. They guarantee to never charge you more than 5% with this particular company that he has.
And he's
okay?
making 10% on it.
How much more is 10 than 5?
Well, 5 times. Well, 500%
No, that's
more.
100%
yeah.
more.
Oh, that's right. Okay, so you're doubling it. Yeah, 5%
So
more. But
he's pulling it out. He doesn't have to write out a check to pay the interest. The insurance company charges 50 grand at the end of the year, and they credited him 100. He made a net of 50 grand. He made a net of 5% tax-free on his money while he was using it on top of what he was doing.
So is this the best kept secret in the financial world?
Oh, yeah.
I mean, you know, is
Well, see,
that what
see,
it
what
was?
you were asking, how can the little guy do it?
Right.
Last year, he borrowed at 5% and earned 25% on the money that he borrowed because he didn't actually withdraw it. So he was earning 25, it only cost him 5. So he netted 20% tax-free on his money while he was buying real estate.
So it's literal when you say be your own bank. You get
Exactly.
to be in the business yourself of banking your own money rather than using these banks, which are just
You can
pillaging.
do this to buy cars or anything or
Yeah.
businesses. This is where I have my working capital for my business. And so, yeah, a lot of people don't know what they don't know, and this is why I write the books, and sometimes it goes over people's heads, and even financial advisors don't get it. Most people, when they came to me, it was through the financial dimension, is what I call it. But Patrick, it's not just about the money. So when I would sit down with people and I would tell them what I did, okay, I help people optimize assets. But when we say the word assets, what kinds of things do most people think of first?
Money.
Yeah.
Yeah.
Real estate, stocks, bonds, real estate mutual funds, and those are just things. Those are just material possessions. So they're the financial assets. But then I would ask them, what are the most important assets that you value, that you cherish, that you possess on this earth?
Family.
Family, health, values. These assets involve people. These are human assets. They are our core assets. And so I put these under the foundational assets for abundant living. It would include your talents, unique abilities, charitable foundations, and so forth. There's a third dimension of authentic wealth, is what I call it. It's our intellectual assets. Wisdom is a product of knowledge times experiences,
Right.
and not just the good ones. I've actually learned more from my bad experiences in life. It would include your formal education, reputation, systems, methods, traditions, alliances, ideas, and skills. So these are the three dimensions of authentic wealth.